Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Winter storm Landon. Do we really need to personalize our storms? Is wreaking havoc across the country. It's a good day to stay inside and, as Fats used to sing, let the four winds blow. All right, let's get started. This week, our three things are: 1. Slowing growth. Q4's extraordinary GDP print feels like ancient history. Best to prepare for what's ahead. 2. ISM manufacturing. The index has proven to be a useful guide to where credit spreads are headed. And 3. Larry Fink's letter to CEOs. Here's what it means for creditors. All right, let's dig a bit deeper. So there was no shortage of buzz around the recently announced Q4 GDP release. 6.9% real GDP growth, the fastest quarterly rate in 40 years, topping off a year, 2021, that grew at the fastest rate, 5.7%, since 1946. Great momentum heading into 2022, right? Well, so much so that it sure seems like the Fed is taking all of that into consideration when stepping up its hawkishness of late. So does it come as a surprise if I told you that Q1 is shaping up to be a real downer, as in quite possibly below long-term trend growth of around 2%? Well, the just-released Atlanta Fed GDP Now forecast reading for Q1 is starting off basically at stall speed, 0.1%. What's going on? Well, if we peel back the Q4 result, we find that inventory rebuild, necessitated by well-publicized supply chain driven shortages and inefficiencies heading into what was expected to be a holiday season for the ages, contributed a disproportionate share, 4.9 percentage points, of that 6.9% growth rate. Then, factor in sagging real consumer spending over the course of the quarter, which ended up in December at a minus 1.1%. So the current quarter is shaping up to be a poor one, certainly in comparison to Q4, as you won't get the inventory rebuild, and you'll have a weak handoff on the consumer spending piece of the equation. The Omicron impact, which hit hard in December, could alleviate, but it won't likely be that large of a swing factor. The fact of the matter is consumers have bought nearly all the durable goods they need. Services have been slow to come back through waves of outbreaks and inertia, and the category isn't as large as durable goods spending even if it did. And inflation is really doing a number on consumer sentiment, which we see clearly in the consumer sentiment surveys. Underneath it all, a new Gallup poll shows that just 18% of those surveyed see the economy as being in good or excellent shape. A year ago, that number was 60%. That captures the transition from a wash in stimulus to a wash in inflation. Meanwhile, the median real GDP growth forecast of the Bloomberg consensus has fallen to 2.8% for Q1 from 4.5% forecasted at the end of November. The lowest forecast of the 59 responders is 1.0%. We would be surprised if we don't have a few negative ones by the time all is said and done. It's time to manage down your growth expectations. Normalization is coming. All right, on to our second thing, the importance of manufacturing. Back in the 1950s, the CEO of General Motors testified in Congress, quote, "As GM goes, so goes the nation," unquote. Yes, the U.S. long ago transitioned from a manufacturing powerhouse to a services-based economy. And manufacturing today represents just 11% of GDP and 10% of total U.S. employment. But we've learned to pay close attention to surveys in the manufacturing sector, as they tend to correlate well with the direction of risk assets, both stocks and credit. Take the ISM Manufacturing PMI, which, as you know, is a diffusion index where readings above 50 suggest economic expansion. From its pandemic low in April 2020, it moved almost in a straight line to its highest level in 38 years of 63.7 in March of 2021. It hovered around 60 for much of 2021, but it has now slid back to 57.6, a still healthy level that is well above its long-term average of 52.8, but the trend is not our friend. The index's measures of both production and new orders dropped to levels not seen since mid-2020, despite the robust inventory rebuild mentioned earlier. Omicron-related interruptions and difficulty finding appropriately skilled workers have also been weighing on manufacturing sentiment. In any event, the ISM manufacturing PMI has rolled over at a time when stocks and bonds have sold off, so that correlation, actually an inverse correlation, is holding. Intuitively, it does make sense, so much so that the old adage still holds. As manufacturing activity goes, so goes the value of risk assets. All right, on to our third thing, Larry Fink's annual letter to CEOs. Over the past few years, BlackRock CEO Larry Fink has used his platform as head of the world's largest asset manager to push for companies to define its purpose and engage with stakeholders, pushing firms in the process to better define sustainability objectives. Arguably, his letters have done more to accelerate ESG investing and stakeholder capitalism in the U.S. than any other force. His annual letter to CEOs, where he elaborates on what he calls a fundamental reshaping of finance, has become a must-read. His 2022 letter pushes back on the cynical notion that his crusade is somehow politically motivated or a thinly veiled attempt to appeal to the woke crowd. He makes an impassioned case that stakeholder capitalism is capitalism, where a company must create value for its full range of stakeholders in order to deliver long-term value for its shareholders. In this letter, he sees the pandemic as a catalyst that has, quote, turbocharged an evolution in the operating environment for virtually every company, unquote. He suggests that there will be winners and losers, where winners will be innovative companies that can adapt to how technology is reshaping life and business, and will be able to define for its stakeholders a clear purpose, a coherent strategy, and a long-term view. He points out that COVID-19 has deepened the erosion of trust in traditional institutions, such as government, the media, and NGOs. Successful companies can fill that void, but it won't be business as usual. Mr. Fink points out that companies expected workers to come into the office 5 days a week. Mental health was rarely discussed in the workplace, and wages for those on low and middle incomes barely grew. In his words, that world is gone. He also points out that broad access to capital, made possible by growth in the shadow banking system, means that virtually every sector has an abundance of disruptive startups trying to topple market leaders. So what does all this mean for credit? Well, to us, it means two things broadly. One, higher costs over the near term from the need to respond to and recast a business to conform to ESG-related preferences. And two, greater volatility. Mr. Fink also acknowledges that we shouldn't expect to get to net zero in short order. Accordingly, BlackRock does not advocate divestment from oil and gas companies, as an example, as a policy. Rather, it's all about how those companies are transitioning to net zero. The good news is that debt-issuing companies today are, for the most part, in solid shape with balance sheets that are stronger than before the pandemic and are reporting record levels of profitability as a percentage of GDP. It's a solid place to start. So there you have it. 3 things in credit. 1, slowing growth. Q4's extraordinary GDP print feels like ancient history. Normalizing will not feel nearly as good. 2, ISM manufacturing. The index has proven to be a useful guide to where credit spreads are headed. And 3, Larry Fink's letter to CEOs. Capitalism is driving sustainability strategies, but threading the needle between short-termism and long-term sustainability will be challenging. As always, thanks for joining us. Don't forget to check in on KBRA.com for our latest rating reports and research. See you all next week.